I remember being in this meeting with the client. I said, honestly, I just have to get past the next 10 years. And it completely changed the dynamic of our conversation. Hey, everyone, I'm Andrew. I'm a CFA charter holder and a CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I take the learnings from those thousands of iterations and I give them to you so that you can apply them to your own life. Today, what I want to talk about is a client who had come in and was jittery about the market. The volatility of the last couple of days made me think of this situation because this person had come in several years ago to talk with us and they were just nervous and beaten down. Their portfolio was down. They had just retired. And you've heard me in other videos talk about sequence of returns risk. They were the real example of sequence of returns risk. And so whenever we looked at their portfolio, they just walked in dejected. However, as we go through the retirement plan, and I actually went and we showed them year by year cash flow analysis, what they realized is once they hit Social Security full retirement age, between that and their pension, and I just did a video on how pensions change retirement, you should check it out. But between that and their pension, all of their income sources covered their guaranteed expenses. Now, they were an early retiree, so they still had 10 years that they had to endure, if you think of it that way, the markets. However, when you looked at their marketable portfolio and you added up their guaranteed expenses and you added up their bonds, they were commensurate. Meaning there was enough fixed income or bonds in the portfolio to provide income for the next decade until Social Security and their pension could do the heavy lifting. And that's when they said, really, I just have to get through the next 10 years? That is cash flow immunization. And whenever you look at stock market returns over a long period of time, over 90% of 10-year rolling periods, the US equity markets have had a positive return over 90% of the time. Now, does that mean from 2025 to 2035 it will be a positive return? I don't know. But I know the chances historically are 90%, and that's an A on a paper. It's not bad odds. And if you look at the 5-year rolling average returns for the aggregate bond index, it just hit its first negative value after the 2022 bond rout. And the 5-year average annual return was like negative 0.7% or something like that. So in every other 5-year period, bonds have had a positive return. Over 10 years, stocks have almost always had a positive return. Over a 15-year period, the US stock market's never lost money. That may not be the case going forward. The only constant is change, but there's a reason that Benjamin Graham said, in the short term, the market's a voting machine. But in the long term, it's a weighing machine. Because we are not made up of these rational economic beings that economists want to make us out to be. We are humans who make up the markets. Okay, humans are the decision makers. Now there's short-term frequency trading and that kind of thing, but we're the ones who write the software for that, and we're the ones who say the software should continue to do it or stop. My point is, when fear takes over, selling typically happens more than buying. And you'll see this with the intra-year declines in a stock market versus the ending year return. It's always the intra-year decline is more than the ending return value. And so a lot of this ends up being a timing game. Bad portfolio outcomes and variability of outcomes from a timing mismatch in the portfolio, a timing mismatch of cash flows in particular. And being able to zoom out and go, man, in my personal business, if I had a 92% chance of having made a good decision, I'd probably take those odds. We should be making those similar types of decisions with our portfolios. Now, your decision may be different because of your own facts and circumstances. And there is always the chance that the world has entered a different type of environment and we have to adapt to that. But at its core, a takeaway that I've always had is that equities are a call option on human ingenuity. Or said differently, if you believe that humans have the ability to continue technological progress and to continue being more productive, you should continue to own equities in some form or fashion. And we can get into arguments on that, hows and the wins, but that's why you own equities, is because in the future, you think you will be compensated for that. And really, it's a bet on humanity. And so my encouragement to you is this: make sure your portfolios are lined up the way they should be. Put the odds in your favor, and then let the long-term money be long-term, and let the short-term money be short-term. Hope this is encouraging. Until next time, see y'all.